Good day. My name is Dennis Egert, and I am the CFO for the City of Medicine Hat. It is my pleasure to present the CFO report for the period ending August 31st, 2024. I'm also joined by my colleagues Lola Barta, who is the Director of Finance, and Wright, who's our City Treasurer. The purpose of this meeting is to continue our transparent and regular reporting to Council and to the community. This particular presentation was presented to Audit Committee on October 23rd, 2024. In this presentation, we'll be covering three areas: current environment, financial performance through August 31st, and other items of interest. So let's start off with the current environment. I do want to highlight some external challenges that this organization has been faced with. Let's start with inflation. Inflation is slowing down, and that is good news for our organization. The Alberta inflation rate through the end of August, year over year, was measured at 2%. This is the lowest level that we've seen since 2021. As a result, the Bank of Canada has been reducing its key lending rates through 3 successive quarter-point rate cuts, and we expect more in the remaining year. The Canadian core inflation rate is also at 2%, which is within the Bank of Canada target. Inflation does impact the cost of borrowing and providing services to our community. I do want to provide an update since this report. The inflation rate has actually dropped further to 1.9% for Alberta, and Bank of Canada has announced a 50 basis point rate cut in October, which takes our key lending rate down to 3.75%. And now a little bit on market commentary. As I mentioned, the Bank of Canada has cut rates and will continue to cut rates through 2024 and potentially into 2025. Our short-term Canadian bond yields have come down, although medium and long-term bond yields have remained unchanged. And those areas in terms of corporate and high-yield credit have performed very well this year. The economy through the second quarter has demonstrated resilience, and however, there are signs of slowing momentum. Signs of weakness, including softened employment data and sluggish growth. On the MSCI World Index return, we've seen that largely driven by information technology, communications, and utility sectors. Electricity prices is another area that is impacting the City of Medicine Hat, specifically the volatility of the export market. Now, the export market is where we sell excess electricity production to the Alberta export grid. And that volatility is showing through 2023 into 2025 and beyond. 2023, we've seen an average price of $133 per megawatt hour. Year to date through August 2024, $71. For the remainder of 2024, $61. And for 2025, $51. And these prices do change each quarter. The power production is unlikely to produce cash flow at the same rate that we've seen in 2023. And in some cases, we're also contemplating negative cash flows in the medium term. The bottom line is lower pool prices to the export market means more reliance on our financial reserves that we've set aside. With that, I will turn it over to my colleagues Lola Barta and Wright to highlight the financial performance for the period ending August 31st, 2024.
I will go through the financial performance for the City of Medicine Hat as of August 31st, 2024. We will begin with the financial position. The investment portfolio had a value of $784 million at August 31st. This is an increase of $51 million from December 2023. The increase in the investment portfolio is primarily due to increased cash holdings and higher investment returns. The net capital asset is $1.4 billion. There has been no change from our 2023 value at this time. Debt is at $423 million. This is a decrease of $14 million from 2023. The lower debt is due to pausing new borrowing during the high interest rate environment. The asset retirement obligation is at $244 million. This includes all of our asset retirement obligations for the entire city. This includes the oil and gas, the landfill, and the building asbestos. This is a decrease from 2023 of $11 million. Turning over now to the operational performance for the municipal. So our year-to-date surplus is $27.6 million compared to a budget of $35.4 million. This is lower by $7.8 million. The primary reason for this lower variance is due to lower realized investment earnings. Our budget reflected our total earnings. However, due to an accounting standard that we changed in 2023, we are only allowed to recognize the realized portion of those investment earnings. The other item is the realized loss on investment currency hedge. And we've also experienced higher wages in emergency services and parks and recreation. Our forecast to December 31st is a $14.1 million deficit. The primary reason for this is the continued lower investment earnings through only looking at realizing the gains from our investments, as well as the anticipated continued loss from our investment currency hedging. There are also higher costs due to understated temporary staff requirement and higher staffing for increased facility utilization. We are also experiencing higher than budgeted employee benefits. Moving on to our operating performance of our utilities and energy division. Our rate-based earnings before taxes, depreciation, and amortization. The forecast to the end of the year is expected to be in a negative variance of $1.8 million, so lower than budget by $1.8 million. This is primarily due to lower demand of electric and gas distribution sales and lower water consumption. We have also experienced some unexpected maintenance in our water and sewer. This is offset by lower internal allocations from fleet and facilities, finance, and our information technology. On the energy earnings before taxes and depreciation, the forecast to the end of the year is expected to be 23.1, lower than our budget. And this is primarily due to the commodity volatility in Alberta. So we've experienced lower budget electric commodity price for our sales to the pool, as well as lower natural gas price. The reduced earnings impacts our free cash flow. So this is the amount of cash that the business units are allowed to transfer over to our into our reserves. This is forecasted to be lower by $49.4 million at the end of the year. And so this will have a negative impact on our financial reserves. Our capital spending is expected to be unfavorable by $3 million. We had an approved capital. This includes current projects as well as previous projects of $739 million. $374 of the approved budget has been spent or committed to date, and we have a remaining amount to spend to complete the projects of approximately $368 million. So the total estimated cost to complete current outstanding projects is $741 million, which is $3 million higher than budget. This is primarily due to various abandonment projects requiring additional work and unforeseen repairs at our electric generation critical infrastructure repairs. I will now pass this on to Ryan Wright, our city treasurer, to talk about the investment portfolio and management.
I'll now speak about investments and debt. I'll start with investment management. The investment portfolio was valued at approximately $784 million as of the end of August. That was up approximately $50 million from the end of last year, so returns have been quite good. You can see that the year-to-date performance as of the end of August was 9.29%, and that slightly outpaced the benchmark of 9.14%. I can update that as of the end of September. Things are looking even better. We were sitting at 11.65% as of the end of September versus a benchmark of 10.83%. So portfolio continues to do very well this year. The investment strategy continues according to our plan. We have many top-tier investment managers, actually 12 currently in place across a number of different asset classes and geographies. So the city has Canadian and global fixed income and equities. We have infrastructure, real estate, private credit, commercial mortgages. We also have a currency overlay to hedge our currency exposures on the investment portfolio as well. We do take a long-term approach, so we try to, look past kind of shorter periods of volatility and try to focus on achieving those long-term returns. One other thing that we currently have underway is a refresh of the strategic asset allocation study. So we did that previous one back in 2021. And that is now fully implemented. So we decided, every 3 to 4 years is kind of best practice to refresh that analysis. And we're anticipating that the results of that study will probably, mostly validate kind of where we're at, with only incremental changes likely to be suggested. So overall, the investment portfolio is, very well managed, very well structured, and continues to perform very well. Moving on to a bit of a discussion as to kind of how different segments of that investment portfolio have performed in the current market environment. So in terms of the economy, the broader economy has demonstrated resilience throughout the second quarter of the year, with signs of slowing momentum kind of continuing into Q3. I mean, the good news is that it appears that we will avoid a recession and have the softer landing scenario where we can essentially tame inflation without tipping the economy into recession. Global and emerging markets had a very strong performance in Q2, and our allocation to global equities did particularly well in the sectors of information technology, communications, and utilities. Canadian fixed income, as well as our global fixed income, has continued to benefit from central bank interest rate cuts, and that is expected to continue throughout 2025 as well. As shorter term interest rates go down, that essentially increases the prices on our fixed income holdings. And in terms of our private market asset classes, infrastructure and commercial mortgages have done very well. They've exceeded expectations year to date. Real estate struggled a little bit through the first 2 quarters of this year, and that's kind of continued over the last year and a half to 2 years. It's basically all real estate markets. But the good news is in Q3, it seems as though we may have seen those markets bottom out, and the expectation is possibly Q4, almost certainly in Q5, we'll see positive returns coming from the real estate portfolio as well. And that will come from a couple of different factors. As base rates come down, it will lower the cost of capital for these real estate firms. It will also put downward pressure on discount rates when valuing the properties, and should have a positive effect on real estate valuations. Next, I'll speak to financial reserves, and I'll keep it fairly high level, as Dennis will address this topic a little later. So as mentioned, financial reserves are sitting at about $784 million. That is up by about $50 million year to date. One thing to note is that the reserves, aren't free money. It's not just uncommitted capital that we're free to spend however we want. That's almost it's almost offset dollar for dollar by the city's financial liabilities. So, 2023 was one of the first years in a long time that our financial assets actually exceeded our financial liabilities, which is a good position to be in, but that won't always be the case. It's possible that our financial liabilities could exceed our financial assets. So these financial reserves are essentially set aside to cover our current and future obligations, be it day-to-day bills, future replacements of assets and infrastructure, asset retirement obligations, if we want to proceed with an energy transition. Basically all these different obligations that we have in the future, that's what these funds are meant to essentially pay for. So most of these funds are either committed or required for future obligations. So on the right side, you'll see that the split of the reserves and sources of funds for the investment portfolio as of the end of August. One thing to note is that the 2 new reserves, the Abandonment Obligations Reserve and the Energy Transition Reserve, have since been approved since the time this report was compiled. And those are to be funded $75 million each out of that unrestricted working capital amount on the top right. The Capital Reserve, is one of it's our single biggest reserve fund, and the Heritage Savings Reserve Fund is our endowment fund, and that has since been renamed the Medicine Hat Endowment Fund. And we also have the operating reserve to cover shortfalls on operations, and we have grants and donations from other entities and orders of government as well. On the debt side, in terms of debt management, the debt was sitting at approximately $423 million as of the end of August. That's down about 14 from the end of 2023, primarily because the city deferred its 2023 borrowing into 2024. And basically at the end of August, we were sitting at around 53% of our MGA debt to revenue limit, and that was projected to rise to 58% by the end of the year. So still comfortably within the MGA limit and also within the city's policy limit of 70% of the MGA limit. In terms of the interest rate that the city's paying on that debt, 3.47% is the weighted average rate of interest, with a range of approximately 1.8 to 6.25%. Annual interest paid is about $12 million. One thing to note is the city is, continuously kind of trying to optimize, how it manages not just its investments, but the debt and borrowing programs as well. As part of that, we are looking at potentially deferring our 2024 borrowing into 2025 to basically be able to borrow at considerably lower interest rates. The province is expected to pass on some borrowing rate reductions of at least 50 basis points in March or April of next year, and we might actually see rates come down as the Bank of Canada continues to lower rates and inflation expectations come down as well. So just to put it into perspective, if we were to save 0.5% on a $50 million borrow for 20 years, the savings could add up to approximately $5 million. That is all I have to say on debt and investments. Thank you.
The other area is other items of interest for 2024. This particular slide we've shown in the past, but it highlights the balanced approach that we're taking. Stability leads to livability. It all starts with a foundation of financial sustainability, just like we would for a household. A financial, stable organization leads to a livable community, which means we're able to create the community we love to live in. Financial sustainability is a necessary foundation for the City of Medicine Hat, and that is one of the 3 corporate objectives that we've set in response to Council's strategic goals. The first goal within this corporate objective includes to balance the delivery of services with competitive taxes and utility charges. That is referring to the current year, 2025, 2026, which is the budget period that we're contemplating. Looking forward into the future, we want to ensure that we have a fiscal capacity and flexibility in order to meet future obligations and consider opportunities as they arise. In the end, it's balancing the needs of today with the requirements of tomorrow. Our fiscal targets that we've set are anchoring our stability. Throughout our 2025 and 2026 budget deliberations, you have seen these targets being presented. Financial reserves, and we have a range of $570 million to $870 million of target financial reserves that we want to maintain over the future. These are required to meet future asset replacement and other obligations as they arise, including abandonment of our assets and oil and gas properties. But also it allows us to consider opportunities as they arise. The next area is debt levels, and this is ensuring that we're responsible with our debt, that we're not overextended, and we're subject to limits that have been set by the municipal affairs of 2 times our revenue limit, and then further through council policy, which takes that down to 70% of that MGA limit. The third area is our municipal budget gap. And we are targeting to eliminate that municipal budget gap anytime we have items coming for consideration to council, whether it's capital or operating. This does have an impact on our municipal budget gap, and we want to ensure that this is out front for consideration as we make decisions. Our financial reserves ensure a prudent approach in terms of how we set aside money for future obligations. Council recently approved the establishment of 2 new financial reserves. through a reallocation of existing funding from unrestricted reserves. Those two reserves that we've set up are the Abandonment Obligation Reserve and the Energy Transition Reserve. These are two areas where we are anticipating obligations for the city into the future, where we thought it'd be prudent to set aside money to be able to support meeting the funding of those obligations. Additional funding will be provided over the years from any available city free cash flow that's generated from the businesses. Dedicated financial reserves will ensure that funding is set aside for future obligations. Another great news story is the Medicine Hat Endowment Fund, which is a forever fund. This is a recent amendment to what is well known in the community as the Heritage Saving Reserve. There was a few changes that we made through the recent bylaw change. The one is that we've targeted a upper balance of $200 million for this fund. Of course, that's adjusted for inflation, so that'll grow. And the principal amount that we have in that fund is protected from any withdrawal. Further, the annual investment income generated from this fund is intended to fund three broad objectives: financial sustainability, economic evolution, and community livability. All the funds within the Medicine Hat Endowment Fund is invested in accordance with our investment policy 0167. The Medicine Hat Endowment Fund is a benefit for the people of Medicine Hat. The Energy Business Strategy Review is in progress, and we're expecting a report to Council before the end of the year, most likely in November. This report will inform future decision-making to ensure that we're providing the best value for the community. It is an independent evaluation of the city's energy business, and it will confirm the overall strategic approach in some key areas: the ownership model related to how we conduct the business and govern the business, rate design and our dividend approach on excess funds being generated, and competing trade-offs and complexities that are inherent in an electric generation business. The community survey is another area that we recently received through the 2024 Ipsos survey. It is a survey that's conducted every second year, and it is posted on the city website. What we found is that there's a satisfaction with most city services. That satisfaction remains quite high. Affordability, social issues, and governance and leadership, those are concerns, and that have increased from the first survey. This is reliable data to understand community sentiment around certain topics. We consider this survey representative of the population of Medicine Hat, and we will use this in further planning and decision-making. The last area is the bid for the Memorial Cup 2026. Hosting this Memorial Cup tournament will be a significant event for Medicine Hat, and we feel confident that Medicine Hat has a strong bid and will be competitive. The results of the winner are expected to be announced in December, and this one is being hosted by the Medicine Hat Tigers Hockey Club. That club was formed in 1970 and have never hosted a Memorial Cup before. Again, there's 5 clubs that have submitted a bid to host this tournament. The Memorial Cup, for those of you that aren't familiar with it, is a premier hockey tournament for top Canadian Hockey League teams in Canada. Thank you for the opportunity to present this report. If you do have any questions, please submit them through the website online, and be happy to answer any questions or provide any more context. Thank you.